Good evening, everybody. Sorry for the delay. It's darn computer seems to goof up. So welcome. Hope everybody's having a nice fall evening. We're going to be looking at the wedge breakouts tonight. And the reason we're doing this is as kind of a precursor to the October 19th breakout session, which is very instrumental or very instructional as far as getting your eyes or your visual analysis set up to see where the best likely trade breakouts or the big moves are about ready to occur. So with that, this is what we're looking for. Breakouts, where do they occur? So what we're basically doing is trying to get our eyes trained to see where that new investor sentiment will be taking place. Now, obviously, we can analyze market trends based upon where reversal signals occur as far as the stochastics, where the buy signals occur. I mean, this is what makes candlestick analysis so accurate is we see the signals in the appropriate place, we see the buy signals in the appropriate place. Just makes the finding of trades with the exact timing that much more critical or crucial or exacting, I guess is the right word. What we're also looking for is that change of investor sentiment that tells us we want to be looking for something new happening in a price move so that we have a much better probability of participating in that price move. So I always come back to the fact that before candlesticks came along, I was the worst investor in the world. I was even a stockbroker for 8 years. And I realized that the brokerage firms had no more idea about what made prices go up or down than anybody else. So that's why you always hear these money managers tell you, you can't time the market. You just buy good quality companies and hold them long term and you'll be all right. Well, that's usually advice from people that don't know how to time the market. The major aspect of candlestick analysis is it is the graphic depiction of investor sentiment. And when we see a change of investor sentiment based upon a candlestick reversal signal, we have a much higher probability of being in the right place at the right time. So wedge formations allow us for being prepared for the next price move. And they're basically formed by witnessing a support and resistance level that becomes obvious. And that's usually by being able to draw a line through the tops and a line through the bottom, and the trading range keeps compressing. So that first aspect of seeing the support and resistance is merely identifying this kind of wedge, where the support is, where the resistance is. Now, that compression is what we're looking for. We're looking for a breakout of that compression. So every time we see kind of a top, we can draw a line across there. That's pretty much obviously that's where the resistance level is. Same scenario on the bottom side. If we can draw a line up through the bottom, well, we can see how this trading is starting to compress. Now what are we looking for? Either a breakout to this side or a breakout to this side. And we have the advantage of once we see that candlestick signal breakout, we know exactly what's happening based upon the signals that told us that it's time to be buying. Where do we look for the next resistance? Up here. What do we need to see as far as a complete change of investor sentiment? Basically, we need to see that it's not resisting anymore at that level. So this compression of the trading range is pretty much telling us the same thing that we would see in a doji or a series of dojis. More of a doji, that there's indecision between the bulls and the bears. That compression coming out to the point of a wedge is the same scenario. It's telling you there's starting to be indecision between the bulls and the bears. Why don't we consider the wicks when we draw support and resistance? You can do whatever you want. Basically, what you can see is it tops out here and it bottoms out here. I mean, it doesn't matter what the wicks are doing. If you can see that this trading range is compressing, and you can pretty much draw a line through whether it's the actual candle or whether it's the wicks, doesn't really matter. It's pretty much telling you at those levels, that's where the decisions are being made to go the opposite direction. Same thing up here, sell signal, a wick, a candlestick signal, and then testing it one more time. So don't get, remember, it's the trading range. It's not necessarily the candles. What we're looking for as far as candles is, do we have a buy signal again here at the bottom of the range? And what type of signal do we have when we come up here at this level again? It's giving us that much more information. So everybody wants to know the definitions. What is a declining wedge? Obviously, a declining wedge is when you can see everything's heading in a lower direction. The highs are lower highs. The lows don't necessarily need to be lower, but you can see pressing in this direction. An uptrending wedge, different scenario. You can see how it's pressing up. See, they're not backing off, and there's your resistance level. Now, to be honest with you, when everybody would say, oh, when you got to the end of the wedge, you know whether it was going to go this way or this way. I could never figure out what they said to tell me it was either going to go this way or this way. But when candlesticks came along, it pretty much told me which way they're planning to take it. If we have an ascending wedge, is it pretty certain that the breakout going up as opposed to a dropping wedge? No, not necessarily, Jake. That's what I'm saying right now is this. Can you assume this is going to be a breakout to the upside? No. This is why the use of, or the visuals of candlestick signals give you that much more evidence of which way they're going. And this is why I always tell people, let the charts tell you what the trend is doing, no matter what you're looking at, whether it's a pattern, whether it's sell in May and go away, whatever adages or whatever patterns you see out there, you've got much more clarity by knowing exactly what's going on in investor sentiment at times when something is supposed to happen. Well, in this case, yeah, you had the kind of the doji. And so what do you have when you have a doji gap down or doji sell-off? That's pretty much telling you which way they're planning on going. And what was the confirming indicator here, or the confirming analysis? Well, they broke through the bottom of this wedge. That's the direction they're planning on going. So anytime we see something in Elliott wave, diagonal breaks in opposite direction to slant. Alan, I don't pay too much attention to Elliott wave, not because I'm not paying attention to it. It's just because I get much more information analyzing visually what the investor sentiment is based upon candlestick signals. The major information we got out of Elliott wave was prices move in waves. And he even himself said it's very subjective. That you usually have a wave 1, wave 2, wave 3, wave 4, wave 5, and then you may have an A, B, C retracement. On the other hand, he said, but you might have a wave 5, wave 6, wave 7, and you might have an intermediate wave in the uptrending waves. So I always kind of give the illustration that when I belong to the Market Technicians Association in Houston, Texas, you might have 10 Elliott wave people in the meeting. We'd put up a chart and they'd ask for those 10 people to give us an evaluation based on Elliott wave. You'd get 40 different opinions. So it's very subjective. So the only real thing that you want to glean out of Elliott wave is moving waves. Let's see. Let me get to a better chart. The black line is your T line. The blue line is your 50-day simple moving average. Let me see if I can find another chart. Okay. With the pattern expectations, let me go through this real quick. The black line is your T line. T line is probably the most important trend indicator on anything, but when you apply it to candlestick analysis, the one chart that I use as my most important chart is if candlestick signals are the graphic depiction of investor sentiment, tells you exactly what's going on in the investor sentiment, and the T line acts like a Fibonacci characteristic indicator. It acts like a natural support and resistance level of human nature. So when you combine those two, Rick or Becky, can you type in for Don that he might have to hit his red X and re-enter? But anyways, if you combine the fact that the T line is a natural support and resistance level of human nature, and the candlesticks are the graphic depiction of investor sentiment, when you combine those two, you've got an extremely powerful combination of what's going on as far as investor sentiment in that trend. I've heard that rising wedges are bearish. Again, don't put all your weight in that. Voice fading shouldn't be. I sit here and scream and yell. If you're having problems with your, it's going to be from your end likely. Go up to the red X on the top right hand part of your screen, click on it, and then come right back in again. Okay, so if this is what we can start seeing setting up, what is our assumption? Our assumption is we might be in a wave or a wedge formation. So once I see that wedge formation setting up, what's my inclination? Unless I'm trading real short term, I'm probably not trading this wedge, but I'm watching it until we get to a breakout point. So this right here tells me if I cut the chart off right here, I'm saying, oh, maybe we're not going in any major direction, that it's moving sideways in a wedge formation. So if I can see things that I can add to the analysis of a wedge, a slow curve, a breakout above the T line, a breakout through this level, just gives you that much more evidence that there's now a change of this compression here, that we have the possibility of a strong price move. So what does a wedge really tell you? That there's indecision between the bulls and the bears. So here's my horizontal wedge. If I get back here and see it heading up, what's my expectation that we're not going anywhere? When it comes back down here and starts supporting, what's that telling me? They've supported at the bottom. If it gets back up here, what's my expectation? Well, if they're not selling it off, maybe this is the breakout. And notice what we had as far as additional information as far as a breakout. Look where the doji occurred, right here at the resistance level after a big candle. Now we've got much more analytical ability to say, if this opens positive, what's our doji rule? Doji rule says it's going to trade positive. And if it's trading positive, what type of signal or pattern could it be setting up? A doji sandwich. And if we know a doji sandwich is setting up, what can we pretty much estimate? That this candle right here is going to be the same magnitude as this candle right here. What's that tell us about our wedge? Tells us we've got a wedge breakout. So where would we be buying? Right here, knowing that if it opens positive after a doji, it's probably trading positive, and we can calculate a wedge doji sandwich, a breakout. We're in immediately and profiting by everybody else coming in. Oh, Harry, yes, I'm sorry. I forgot to go through all the moving averages, didn't I? Let me find one here. Okay. The blue line is the 50-day simple moving average. The red line, which isn't real red on this chart, is the 200-day simple moving average. Those are on our charts because every major money manager around the world has those on their charts to use for making their decisions about their portfolio. The black is the T line, the 8 exponential moving average, which has a very simple trading rule. If you see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. With the caveat that the further away you move from the T line, the higher the probability it's going to come back and test it. So if I'm buying here, how long do I hold on to this? Until I see a sell signal and a close below the T line. Now, what does that do for me? Well, in the old days, before I started using the T line as a natural support and resistance level, I might have taken profits right here. With the idea I can always buy back if it starts back up. But if I took profits here, what was I usually doing? I was taking my money and going off someplace else. Now at least I know to hang on to this position until I see a confirmed sell signal and a close below the T line. Oops, I still didn't do it, did I? So the black line is the 8 exponential moving average. This gray line, I can't remember. Sometimes we had the 20. I now have the 34 EMA, which seems to work fairly well. Now, some people ask, well, why do you have the 34 EMA on here? Because it works somewhat well. And that's the nice thing about candlestick charts, is the reason we're putting on the 50 and the 200 is because everybody, all the major money managers make their decisions. Oh, TES, if your sound is breaking up, click off on the red X and then come back in and see if you can get a better connection. Sound's still breaking up tonight. Is that happening to everybody? All right, so if you're having problems with sound, click off and click right back on. Sometimes you get a better sound. So some people will say, well, why don't you use the 50 EMA and the 200 EMA? And the reason for that is we're not trading off the 50 or the 200. We're watching to see what everybody else is doing at those moving averages. So this is what, and again, let me kind of regress. When we do, on October 18th, we are going to be doing a full day training on identifying when a big breakout situation is likely to occur. And the T line is going to be a major aspect of that analysis. And so here's what I was alluding to is the nice thing about candlestick charts is the number one criteria for telling us there's been a change of investor sentiment is the signals themselves. The T line acts as a very good trend confirming indicator. The other moving averages act as good areas to watch to see if they're going to be on the as a support and resistance level. Solomon, you can put the T line on any platform. All it is the 8 exponential moving average. So just like you would put the 50-day simple moving average, you go to your criteria setup and put in 8 exponential moving average, and that's your T line. On ocular, let me go back and look. On ocular, on this day, yes, I might have closed it out, but notice what was happening here is that we've had a good uptrend. This may be the day to sell. But what do I want to see? I want to see confirmation. So if it opened lower the next day, I'm closing it out. If I held on to it, because the longer you hold on or the longer it stays above the T line, the more compelling you want to see there's a change of investor sentiment. So if I'm holding, and then it closes back here, my next criteria the next day is it has to open positive and trade positive to stay in it. If it opens lower, close out the position. Let's see. Okay. Is that, Jake, is that a reasonable explanation? So there's a lot of times where if I'm in an existing trend and I have a day where it actually closes below the T line, I want to wait to see if that's the actual reversal. Now, where was I? I can't remember where I was. This one? Oh, yeah, the doji sandwich breakout. And this is a function of using or identifying the pattern and then having the advantage of knowing what bullish signal looks like to tell us that they're probably breaking out. So instead of buying up here, we're buying right here and already in a profit mode. So again, this is where it helps us get in at the obvious entry points. Either if I see this and I see that it's breaking down, remember, we've seen a doji evening star signal at the top. Then it closes below the T line. Still not, I mean, we have that simple rule that if it closes below the T line, you're more likely now in a downtrend. But we know we're in a wedge formation. So where's our ultimate indicator to tell us we can start going short? Probably on this day right here, because we've got the evening star signal, close below the T line, and now we're trading back below the bottom of that wedge. Yes, but that's, Jake, that's only true the longer that trend stays in existence. That I might not get out the first time it pops up through, might get out here. But then again, I would have gotten back in short because it's doing our next pattern. But we're digressing. Here was our confirmation that the sell signal at the top of the wedge and the close below the T line and trading below the bottom of the wedge told us the force of the sellers were now greatly in our favor on a short side. Same scenario here. You can see how you've got a wedge formation. Now you've got a little, notice how it came up above the T line and we're right here as a doji right at the wedge. When they gap it up, what do most people think immediately? I say most people because I did the same thing back before candlesticks came along. Man, I don't want to chase this. I'm going to wait for it to pull back so I can get in at a better price. Now we at least know if we've got a best friend, which is a doji gap up through a wedge breakout, we want to be buying immediately because there's now a drastic change of investor sentiment. Same scenario right here. A wedge formation. When to buy? Well, it looked like it failed here again at the top of the wedge, but then they gapped it up the next day. There's your best friend signal, which is a doji gap up through the top of the wedge. You want to be buying. There's now a brand new perspective of investor sentiment. So if you're in a wedge formation, what do you want to do? Well, if I'm trading, looking at this, I'm not paying attention to this until I see it either come up through this level or go down through this level. Oops, I scrolled down. Okay. Okay, let's see. Let's go. These are the things that help you identify that there's either going to be a blast to the downside or a blast to the upside. So if I'm sitting here, I'm seeing this compressing, what am I looking for? Seeing which way this is planning on going. Where would I be buying? Probably right here. Because that would tell me after a doji and they're trading positive, which way is it going to move? It's going to trade positive. Now, do we always get a move like this? No, but what we're trying to do is put ourselves in situations where we're getting in with a high probability that we'll be participating in moves like this. No, just as long as you can see whether it's a green candle, red candle, just as long as you can see that you could draw out through where the trading ended one day and started going the opposite direction. You're just trying to see where the trading range is. Jake, not really. I say that there's probably a there might be some very sophisticated formulas out there, but this is why the visual aspects of candlesticks is a huge advantage over trying to formulate watching. Let's say you bought this on this, what looks like to be kind of a best friend breakout. Oh, a little slow curve. That's what I had. Then you had your evening star signal. Where was your sell stop on this trade? Right here. Because logic says if you see a doji in the overbought area away from the T line and they come back down through the low of that doji, which way are they going? They're going back here. When would it be time to get back in? Well, there was your next buy signal, but it didn't confirm. Pulled back again. Another buy signal. Didn't really confirm. Now you can see that you're not really going anywhere, but you can identify that you're starting to have a wedge formation. So my wedge formations aren't necessarily because I've scanned for them. It's because I've seen them developing based upon other scans. Yeah, so the visual, this is why the visuals of candlesticks is just logic put into a graphic depiction. Where would your purchase and stop be, JJ, on which one? I'm sorry. I mean, if I was watching this and I saw them trading lower, maybe I have a sell stop right here. And then if I shorted it here and it came down here, I'd probably have my stop, safety stop right here. Because if it came back up through that level, where is it? It's right back into our wedge formation. On Fang, if I bought this right here, where would I not want to see it close, or where would I not even want to see it trade? I wouldn't want to see it trade back below the T line, because what did that tell me about my wedge breakout? It didn't occur. If I'm buying a wedge breakout, what is my first expectation? That it's breaking out. It should be heading in this direction. That's what the results are of a breakout. So if I bought here, and then all of a sudden it came back down here, I don't have a wedge breakout. Get back out of the trade. Do wedge breakouts test the resistance line more than other breakouts before continuing up? Do wedge breakouts test the resistance line more than other breakouts? I don't understand what that means, Steve. All right. Nancy says you can scan for breakouts or wedges. All right. So what's the analysis benefit from candlesticks? Because we can see what type of signals are occurring right there at a breakout level. So there's our bullish Harami, the bottom, and a gap up. What do we know about a bullish Harami gap up? It tells you not only has the selling stopped, but the buying has come in with great enthusiasm. What other elements can we apply to this wedge breakout? Well, they couldn't get back below the 50. Every time it hit the 50, they were buying again. Stochastics were coming up. So that puts us all in positive probabilities that we're heading in the right direction. Oh boy, no, Keith, it all depends on the time frame. You could have a wedge formation setting up on your 10-minute chart if you're trading intraday. And I think that even happened today. I forget what it was in. I think it was the Dow. There was a little wedge set up on the 10-minute chart. But it doesn't matter. All you really have to do is see that there's compression. Again, yes, 1233 are my stochastics, and that's nothing set. I think, I can't imagine how many years ago it was. A few decades ago, when I was first learning candlesticks, the normal stochastic setting was 1455. But as I kept looking at that, I said, well, that seems a little bit slow for what I'm doing, because I'm a swing trader. That means my trades are going to last anywhere from 2 to 10 trading days. So I just tweaked around, tweaked around one night, and I kept tweaking, saying, all right, do I use 1431? Do I use 1252? And I just came up with 1233. That was pretty accurate for showing when the bottom was and when the top was. And so it's worked successfully for me ever since then. That doesn't mean you can't tweak it yourself to try to fine tune it. Now, when I was trading the E-minis off the 1 minute, 3 minute, 10-minute chart, I used a combination of a 1233 and a 522, because that way I could see what little jogs were happening, whether the trend was ending or whether it was just a little zigzag in that trend. When a wedge breaks out of the channel, does it? And okay, we did that. It just seems to climb. Remember, that's what the whole point of a breakout is that the bullish sentiment force was so strong that it's going to continue without usually coming back. Now, that doesn't mean to say that everyone goes straight up. If it does go up and it comes back on into the wedge, you close it out, because that means it hasn't broken out of that formation. So this is what we're looking for, getting ourselves put into positions where when the breakout occurs, we're putting ourselves in a trade where the probabilities are not only strong that we're heading in the right direction, but we're heading in the right direction with a very strong uh, upside potential. And that's the whole point of finding the wedge breakouts in the first place, is because we have an expected result that's going to be much bigger than merely just a uptrending stock. We're looking for that explosion of investor sentiment telling us they're moving out of this wedge, and there's going to be a strong move one way or the other. So that's on the wedges. There's all sorts of candlestick breakouts that we're going to be going through that are very easy to identify. And this is the whole point of being able to identify what should happen after a breakout. Because the rhetorical question is, should you buy a stock after it's gapped up 5, 10, 30, 80%? A lot of people say, oh, I don't want to chase after that. What we want to do as a candlestick investor is say, all right, we see there's a strong new investor sentiment. We want to be buying based upon the results of seeing what the breakout pattern is, so that we can, even though it might be up 10, 12, 20, 30%, it might be another 400% to the upside. Oh, Gail, is that? I'll have to bring up live charts here in a second. Same scenario on the downside. When you've got a trend and then you've got a strong sell signal, like a kicker signal, that's what we're looking for, is that break, in this case, a breakout to the downside. And that's based upon a strong candlestick signal, kicker signal, that came down through the T line. And where do you think our next likely target was? Well, first we're watching to see what happens here, and then we're watching to see what happens here. JJ, yes. As we get into the winter weather, we are going to be doing more, be more training on Tuesday and Wednesday nights for members that show things like where we set our stop losses, how we affect our entry strategies, where we improve the probabilities of being in the correct trade at the correct time, how we do our scans. And we're going to be doing a session. Most of our people in the chat room or in our membership area use the Thinkorswim trading platform, which can also be used as a scanning platform. So we're going to be doing a session here in the next week or so, showing people how to set up their scans more effectively using Thinkorswim. So the whole concept of the Candlestick Forum is to convey information as well as providing good trade setups, that not only for providing good trade setups so that you can analyze why that trade was setting up correctly to be in the correct trade at the correct time. Carl, I use TC2000 also. We also use Metastock. But a lot of people, if they don't want to have a combination of TC2000 or Metastock as their scanning software, but if they just want to use one platform, Thinkorswim. The reason I use Thinkorswim is not so much for the scanning abilities, because trying to teach an old dog new tricks. I've been using TC2000 and Metastock for years, and I'm already accustomed to how to use those. But it's very simple to do the scans on those platforms. So, anyways, we will be doing that here pretty soon, meaning within probably the next couple of weeks. And that's kind of the advantage of the chat room. Twofold is that if somebody puts up a chart or a suggestion saying, take a look at XYZ, it's doing a such and such signal, now you can go and see it immediately. So it kind of expedites your learning process and understanding what moves prices. And I often tell people, prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. You would have gotten in on, down on November 1. I can't even read. November 1. Well, see what happened down here? This was more to illustrate. There was your sell signal. There was your first target, didn't hold. There was your next target. Now, why do we have the 50 and 200? Because that's where everybody makes their decisions. And Rami, Doji, there, what did that tell us about the 200? It's probably the support area. That was the time to start taking your profits on your short position. So it just creates a high probability platform or visual roadmap to show when to be selling and when to be buying, or vice versa. So this is the whole point of utilizing candlestick breakouts. Where do they break out? Fry pan bottom, right about the same level as the pattern starts. Fry pan bottom. Where did it break out? Right here. A bobble breakout. Very simple to identify. Failure at the resistance level. Where did it pull back? Right to the T-line. What was it setting up? There's our J-hook pattern. Except this J-hook pattern is much more defined because you can see where it failed and you can see where the J-hook pattern confirmed. So not only do you have a J-hook pattern that you can see exactly where the selling occurred and where it was breaking back out, if you took out the T-line or took out the 50, you could see the J-hook pattern. You could see the confirmation of the J-hook pattern because notice what the next signal was. There was your doji sandwich telling you they were continuing higher. There's your breakout kicker signal. How long do you hold on to this position? Look how choppy it was. Without the T-line, I may have come out a couple of times. Well, if I came out, I probably wouldn't have gotten back in because I'd have put my money someplace else. Now I can sleep comfortably knowing that as long as it doesn't close below the T-line, I can hang on to that strong signal result, the kicker signal, until I see a sell signal. This is what we call the message. Big gap up. And then they sold it off. That's not a bullish candle. But what was the message? The message was they gapped this one up and started taking profits. So where do we want to start buying? When we can see the profits over, or the profit taking's over, and that the buying now starts back up again. So these are the things that we're going to be going through, and this type of analysis. A Dow, wave 1, wave 2. What started wave 3 on the Dow? Held up above the 50, and then your best friend, wave 3. Would be expecting more upside. Bobble breakout. Might be taking profits in here. When are we buying? We're buying back here. Now, when I say buying back here, before candlesticks came along, if I happen to be lucky enough to be in a bullish trade, and I say, oh, it's failing at the 50, I'm getting out, I wouldn't get back in because my skewed thought process was, oh, they're not going to trick me and get me back in, and then turn right around and take some profits. At least now I know what human nature does and what type of pattern I should be looking for. So if I'm taking profits here, I don't have fear about buying back here because out J-hook pattern, what's my expected move? Wave 1 and wave 3, you're probably going to take me up here to fill this gap and test the highs. Trend breakout. Where did it occur? Right smack dab off the 50. And a close above the T-line. What's that telling me? I can stay long until I see a sell signal and a close back below the T-line. A resistance breakout. How did it get there? There's your best friend. Gap up. Notice where it gapped up to. Right at the breakout level and went positive. So this gets rid of that hesitation or that fear saying, oh, it's gapped up and it's trading positive. I don't want to chase it. Yeah, you want to chase it because that signal right there is telling us there's a brand new dynamic in this this price move. Why? Let's see. Oh, the green line is the yeah. Is it on here? The 3T line, the 3 EMA, and it's got confirmation that if it stays above the T line, that they're not selling it off. So that'll be a whole nother training session. This is the type of breakout we're looking for. Bullish engulfing. The T-line crunch. Notice here's your resistance level. And they're crunching it right up to that level again, getting ready for your breakout. So this is not stuff that you use every now and then. Look what the Dow is doing right now. Kind of a wedge formation. What's that tell us about our overall movement of the market? It's probably not going anywhere until they either break out to the upside or break to the downside. Now today did a bullish flutter kicker signal. And as if you read the afternoon newsletter, we kind of anticipated a bullish day today. And why was that? Because yesterday, if you can see this, we'll do it on live charts here in a little bit, that we had a gap up doji above the open of the dark candle yesterday, that if it opened positive today, it was going to trade positive, thus giving us a bullish flutter kicker. So why is that relevant? Because we know exactly what that bullish flutter kicker, how it sets up, and which direction everything should be going. So there are always patterns out there. Tesla, you can see the wedge. You can see it's just now broken through the top of that wedge. Where do you think your next likely target might be? Probably right up here, which would also coincide with kind of filling the gap over here. We were buying, oh, I didn't even put this on, NVIDIA today. Or actually, I bought calls on NVIDIA yesterday because it did a doji at the top of the previous day's bearish candle. So we started buying calls because if it opened positive today, what do you think was going to happen? It was going to trade positive, and what type of signal do you have? Again, a bullish flutter kicker signal, which is essentially a kicker signal with a little flutter in here. If you took that doji out, you basically have a kicker signal. More relevant on the Apple chart. There's your bullish flutter kicker right here at a breakout. And if it came up through or traded positive today, what that tell us about this whole breakout area? We're in wave 3, more upside. That does two things for us. It either makes Apple a good option trade, or if you're buying the stock with probably the options, have a high probability it's going higher, probably maybe to the top of this trend. And two, if Apple is trading positive, what do you think the overall investor sentiment is in the market out there? It's probably positive. They aren't bailing out of this market. So anyways, this is what has dramatically taken me from being the worst investor in the world to where now I can consistently pull money out of the markets, because every time I put on a trade, not only do I have the probabilities of making money with that trade, but I've got the ability now to find the trades that are going to produce a much stronger profit than just merely an uptrending stock. So this is where you mark your calendars. We call this the Big Bang Breakout. For non-members, it's $297. We usually promote it as a 4-hour session. Unfortunately, as most people have found, our 4-hour sessions usually stretch to 6 hours. For members, it's $1.59. So everybody always asks, well, why don't I just join as a member and get the lower price? That's what we're trying to make you do. Because the one thing I try to promote as far as the Candlestick Forum website is you're going to get a lot more value than just learning how to use candlestick signals. Did I say $1? Jim, no, I'm already married. The date is October. What is it? The next October 19th, Saturday. So, Becky, do you have the link? We'll put the link in here. Well, let me take a quick look here. There it is. Whoops. No. Dang it. This is great. It's like watching a monkey. Okay, thank you. Okay, so let's try this real quick. Let me see if I can bring live charts over. Okay, so somebody was asking, are the Qs, is that? That's kind of a wedge formation also. You can see the top's declining. So that means as long as it trades in here, you probably, why does members have to pay? Members pay a discount, Jim. Now, if you've already taken the session, you only pay once as a discount for members. And then if we do the same session 6 months from now and you've already taken it, that's when you come in for free. So yes, you do have a wedge formation setting up here. Now there are charts where you can look at them and say, there's nothing going on here, like an Amazon. Make this a little bit bigger. That one's not real compelling. But Netflix today had a nice big compelling chart. On Apron, yeah, it's not what I would consider a wedge, really. I would have closed it out today. It needed to stay above the T line. Now, remember, when it closes below the T line, your probabilities of a bullish trend is dramatically diminished. The probabilities of it trading lower is greatly improved. So if you're long, you have a very simple rule. If you're buying based upon a buy signal and a close above the T line, you close it out if it closes back below the T line. Oh, did I do Bidu? Bidu I was going to put on here because you can see there's kind of a uptrending wedge. Let me. So you got it slow. So it wouldn't be what I would consider a real pricey move trend or a wedge. But you do have a morning star signal bouncing off the bottom But if it opened positive, at least I can kind of calculate my next move is probably the top of that trend. And TLRA, yes. Now, if you didn't close it out today, you still have a Morningstar signal. Stochastic's coming up, but you close below the T line. If you didn't close it out, then you've only got one trading strategy tomorrow, which is it needs to open positive and trade to stay in it. If it opens lower, close it out because your probabilities have gone dramatically against you. Brad, all right, good. That's, again, the one thing that really has dramatically improved my trading through the years was that I have already mentally told myself that probably at least 1/3 of my trades are not going to work. That gets rid of my emotions. And that was the whole point of me learning candlesticks in the first place is, again, being the worst investor in the world, I knew that my emotions were what were killing me. So now all of a sudden I found a trading platform or trading strategy that has high probability results. And when I finally told myself that 1/3 of my trades probably won't work, that got rid of the emotional stigma of, boy, if I do a bad trade, that makes me really look stupid or makes me more dumb than I already am. No, it just told me that trade didn't work. Close it out fast. Again, the old adage that you cut your losses short and let your profits run. I've heard that for 40 years, but never heard anybody tell you how you do it. Candlestick analysis just makes it very simple. When the probabilities go against you, close it out and move on to one where the probabilities are in your favor. And that's the nice thing about scanning for candlestick signals and patterns is every single day, no matter how bad or how lethargic the market is, I've got 3, 5, 7 good long positions to look at. I've got 3, 5, 7 good short positions to look at, and I'm only going to do 1 or 2. So I'm always got more supply of good trades than what I'll be able to use. So that gives me the opportunity to cultivate through them to find out which ones are will be the best or the highest probability trade the next day. Yeah, Rite Aid, you have a double bottom, you have the inverted hammer. Where's your next likely target? Probably up here with the 200. Is a wedge, not because of high. Yeah, I'd give it more. Yeah, you could kind of construe a wedge, but I would give it more the double bottom, especially off the 50. I'm looking at Microsoft these days. Well, see, Microsoft, I've never traded it because it's too big of an institutional trader, which means it doesn't move very well. So this is a typical chart that you can look at this and say, which way is this price moving? It's not moving anywhere. I'd have my money someplace else. So that's the other advantage of candlestick analysis. Not only does it tell you when a signal or pattern is setting up for a high price move, it's also telling you which ones aren't moving, move to something else. HTHT, you can see I can't tell because I'm partially colorblind. You got kind of a bullish flutter kicker on this one. Kind of a support level here. That one has high probabilities of moving higher. Win also not only has done your doji, bullish harami, bullish confirmation, but in our option trading room, it was pointed out that there's been a 4-point bottom here. That's a pretty strong support level. Again, this one you can start buying on positive trading, especially if it started coming back up through the T line with the idea you watch to see what happens once it gets to the 50-day moving average. So we're always looking at things that have a higher probability. Look at our little scoop pattern on Visto. We're recommending this one tomorrow because notice how this one has started. I still can't see the difference between red and green. I'm colorblind, which makes it bad when the stop sign is sitting in the trees. But there's your bullish doji sandwich off a left-right combo, scoop pattern. What do we expect out of a scoop pattern? A slingshot effect. Where's your upside potential? Up here at the 200-day moving average. And we can identify the different sectors that are doing well. For example, the oil shipping stocks are doing extremely well. Notice what's happening in GLNG. Gap up through the resistance level of the 50. That gap up told us there's a brand new investor sentiment. That's why we were buying Scorpio tankers a while back. Notice where the bullish Harami doji occurred. Right smack dab on the 50. Now what's that tell us? That tells us that the selling has stopped at the 50. And when they gapped it up the next day, that told us not only has the selling stopped, but they're coming back into this one with great force. That best friend signal, bullish Harami, gap up off the 50, up through the T-line, was just a very high probability trade setup. And how long do we hold on to this one? Stay long until we see a sell signal and a close below the T-line, or if we start moving too far away from the T-line, if wave 1 and wave 3 are getting to be about the same, we go a little bit more diligent as far as watching to take profits. Weibo, look at the little J-hook slow curve, and where did it support? Right smack dab on the T-line. If it breaks out through this level, where do you think your next target is? Just logically where everybody else is watching. Whoops, I was wondering why nobody was saying anything. Didn't scroll. Party City, bullish doji sandwich, fry pan bottom, left-right combo. Yes, where do you think, if this breaks out through this level, where do you think it's going? The 200. Is there skinning software? Not from the forum. We've got the formulas on our website, and most of our formulas are already with TradeStation, Thinkorswim, Ninja Trader. I think E-Trade has it. Metastock. Sell out of the money puts. You can do that. Yeah. So I guess because you have the analysis to see that this isn't going anywhere, yeah, now you can do other trading strategies, which I usually don't do because I'm looking for the ones that have the movement, because that's where the big benefits of candlestick analysis come in, is seeing when how the trend movement, or what the trend movements are. PRTY wedge breakout? No, it's more of a fry pan bottom. I wouldn't consider that so much a wedge. Usually, wedge, you can see this to me is more of a fry pan bottom, just about ready to break out. Roku, we made very good money with this one because we could see how it was basing, and then yesterday it gapped up. We had bought down here as it started basing, or maybe it was right here. We were buying the October 11, tomorrow. We bought the 108s and we sold the 114s. And I think we paid, I think a little under, right around $2 for it, which was my mistake because usually I want to do a 5-point spread. Well, this was a 6-point spread. And Today it was pretty close to 550 because there was only one more day to expiration. So that turned out to be a good spread trade. On Sting, just very simple. Whoops. We're getting up here, might be getting toppy. If you're staying long, right now we're looking for a 45 degree, but as a safety stop, I'd use today's open. If it came back down through there, where do you think it's going to? It's coming back to the T line. Oh, party. I don't want to look at the bigger picture. Because I'm only going to be in this for if I was trading it. Still fry pan bottom to me. And Reggie, we recommended because there was your kind of your fry pan J hook pattern. And what do we have here? We had a morning star signal, make this a little bit bigger, closed above the T line, failed. And then we had a bullish left-right combo. So we got a morning star signal, a left-right combo. How long do we hold on to this one? Well, if this is wave one, we're looking for it to at least break out or test that level. And if it does, now we have the prospect of this type of move. I saw that. Let's see, Tom, we did Netflix. Netflix had a big day. I guess they've got earnings coming out on the 16th. Roku, I saw, was up somewhere up here. When I looked at it, it was up $4, but that's exactly what we would expect, that it was heading for the 200-day moving average. A cup and handle would be something like this. Then it pulls back and does another little curl. That's your handle. So it's what we would consider a classic, where you have a fry pan bottom, then a J hook, and then it starts back up. So it'd look like this, then it'd be another little dip, and then that would be your handle, and then it would have a strong move. If trying to limit any losses to 2% of my account, sometimes I get stopped out before a close below the T line. Is that a good strategy? Do you recommend waiting for a close below the T line? John, the 2%, is that something that is a market consideration, or is that your own arbitrary level of your comfort level? So when people say, oh, I want to put a stop in, or people say you should put a stop in at 2%, 4%, 6%, I always come back with the answer saying the market doesn't give a hoot where you bought. If you were buying based upon candlestick buy signals telling you the bulls were in control, then it doesn't matter how much it moves on it at any given time. You'll own it. If you're buying based upon a candlestick buy signal, you sell based upon a candlestick sell signal. And the other things that add to your analysis is, where are your stochastics? Where's the resistance level? Where are you at the T line? So there have been so many times, for example, if I hold back, I tell myself, all right, if I didn't sell it here, I'm going to wait to see what it does at the T line. Because remember what the T line is, it's a natural support of human nature. So you don't put an arbitrary a limitation on something that has nothing to do with your arbitrary limitation. I also hear people say, oh, I want to make $500 a day. Well, most people have a hard time making any money during the day. Why limit yourself to something that may produce an $8,000 return for you, and you took a $500 profit and went on to something else? That always comes back to some simple, or my simple strategy. You buy when you see buy signals, you sell when you see sell signals. John, there's going to be times when you will get killed, but that's why you use kind of a mixed, money management portfolio. I usually have 10 positions on at any one time because I know the probabilities are that at least 6 or 7 are probably going to be trading positive on any given day. I don't know which ones, and if I have one that's doing terrible and I wait till the end of the day and close it, that terrible trade or that big loss is usually offset by the other ones trading positive. So that gets rid of my emotions out of watching one bad trade saying, oh man, I got to get out. And then all of a sudden it turns around and heads right back up the way it's supposed to. On any given day or any given time frame, you don't know whether after a good, strong move, I'm trying to think of one. Oh. You don't know if on any given day, after a good, strong move, whether an institution says, oh, we've got 240,000 shares we want to close out, and it opens lower. Well, it doesn't have anything to do with what the overall investor sentiment is. It was just that initial supply and demand. Yeah, swing trader, yes, place your stop at a place that tells you shouldn't be in it. There's been a change of investor sentiment. So if I was in this one, maybe my stop was right here because logic says if it came down through that level, I got a sell signal. Now tomorrow, I might, if it opens positive, I'll say, all right, let's put a stop right here because if it opened positive and came down through there, I'd more than likely have a bearish engulfing signal. So everything that you can do on trades with candlestick analysis is just common sense. You don't have to have any preconceived stop loss levels. Every time I put on a trade, oh, I'm shorting here. Where should it not trade if I went short? I better put a stop where it opened. It's trading down here. Not see it trade. I better not see it close back up above the T line. Because this is where most people shoot themselves in the foot. Say, I got a good profit. Should I be taking profits here? You shouldn't be taking profits because you have profits. You should be watching to see what the chart is telling you. Oh, that was CRWD. This one started off nicely, but when it closed below the T line or closed right here, what was the trading trading criteria? It better open positive and trade positive. If it opens lower, close out the position. Now that doesn't keep you from buying back on the next buy signal. But right now, with it closing below the T line, that indicator right there, that T line, says when it closes below the T line, the probabilities are pretty strong that that you're heading back in the wrong direction. Okay, everybody. Closing below or above the T line is one thing, but confirmation of that close is the key. Yes, the close, the two important factors And candlestick analysis is where does it open and where does it close? That's what creates the signals, and that's what tells you what's going on in investor sentiment. Okay, everybody, I've kept us way over time. We'll see everybody bright and early in the chat rooms tomorrow. We'll see you then.